Okay, hello everyone, and thank you for joining us for this Private Markets Insider webinar. I'm Kevin McCaffrey, and I hope you're all staying safe and sane out there. It's September 2nd, and these are incredible times. Most of us could never have predicted. The country is reeling from a pandemic, as well as political and social strife. Meanwhile, public equities seem to be defying the gravity of any given situation that would weigh it down. And I have this large distracting bandage on my face. So I wanted to tell you a tale of how I got this shiner here, battling on behalf of a client, but it's sadly nothing that romantic. Actually, I would ask that you consider this my public service announcement to beware of the sun. If you're not careful, you might get a melanoma on your face and then they'll have to operate. So that's no fun. And one thing though, like everyone dealing with strife these days, I've noticed a couple things from this episode, and I would say selfishly, this is the most important thing to me at the moment. I won't lie. This can't be ignored, which reminds me that everyone has their own problems. If it's your health or your family, you really need to make that a priority. And in a similar fashion, investment professionals have their problems and priorities that may not be obvious. Underfunded pensions, families needing liquidity or just security for the long term, and that may drive decisions. The other thing that I noticed is the importance of a community. Frankly, if I didn't know people that could help, I may not have been fortunate enough to find someone to remove a melanoma in a timely fashion. And then what seems like an urgent matter becomes a deadly one. So today we're not talking about anything quite so dramatic. We're talking about managing investments. But that can be a lot like managing your health. You might get by on your own, but developing a network of experts and a base of knowledge is more than just comforting. It may be a lifesaver. And hearing the various priorities and approaches of insiders in the private markets in particular can help you gauge your reactions and take action in these tricky times. This investment in time, a couple of you have already been on a number of Zoom calls, I'm sure, today, but this investment can be invaluable when you really need it. And in moments of need, you rarely have time or ability to start from scratch. So that's why we're here. We try to help people to manage risk and identify opportunities by building a community among people we trust, other people that have skin in the game. I think that's important. So moving on, we'd like to jump into the program here. I'm going to share my screen here for just a moment because some of you may not have been taking a look at various places you can view the agenda. And I'd mostly like to point out that we're starting off with a 5-minute presentation, and I welcome any of you to use the Q&A feature to submit questions we might address immediately after that quick presentation. We won't spend too much time there, but those questions may be relevant as we move from that portion into the first panel discussion. And for both panels, we're generally discussing the problems and priorities, as I mentioned, of all of the varied group of investors that you see listed here. We have a great group, looking forward to it. And the overarching theme around both of those panels is esoteric opportunities and private equity, in private equity and special situations. Going back to, stop sharing the screen here. And I have a quick program note as we review the agenda. The following presentation is for informational purposes only. None of the information shared or the opinions given are to be construed as an offer to buy or sell a security. If you have any questions for the speakers during the program, use the Q&A feature. We'll answer as many of those as we can to answer any of those questions we missed, and also to start conversations where appropriate. So now I'd like to introduce to you Josh Koplewicz of Thayer Street Partners as a webinar chair. I'm also obliged to note that they're a client of LaCrosse Investments 37.4, which is also a webinar chair and a supporter here today. I'd like to really thank both of them for their support and expertise here. And Josh will be presenting some observations around family-founded companies and direct deals that are relevant to his strategy, or as I refer to it, consolidating ops in mom and pop shops. So if you can forgive me that little play. As background, I'd note that Josh Koplewicz is the founder of Thayer Street Partners, a boutique private investment firm based in New York, providing flexible private growth capital solutions to the middle market. They're focused on business and financial services companies that are typically tech-enabled. And prior to Thayer Street, Josh was an investor at Goldman Sachs in their special situations group, and I'm sure he can raise some other additional highlights that are relevant. So with that, just take it away from here. Thank you, Josh.
Thanks, Kevin. Thanks everyone for your time, and excited to participate. So I'm just going to flip through, just as a quick intro, flip through a couple points just as background on Thayer Street, but Kevin in some ways did a better job than I could do. So just quickly, Josh Koplewicz, managing partner of Thayer Street Partners. We're focused on uncorrelated financial assets and recurring revenue businesses, big focus on unsexy business models. Some of those include real estate services, essential financial services, insurance services, businesses with royalties or subscription streams or funky receivables. Just a few things just further about us. So our team, we're a small team, 7 investment professionals now. We're from places like Goldman, Fortress, Blackstone, Macquarie. Folks have done institutionally focused private equity and private credit. But one of the key themes, in addition to looking at businesses with lower correlation and recurring revenues, are really examining the lower mid-market. And so some of the observations I'm going to share today is what we're seeing in the lower mid-market. And our edge at Thayer Street, and what excites us, is kind of applying both the investment lens of larger scale private equity and private credit, as well as the operational tools and efficiencies an active investor or a thoughtful investment partner can add, and bring it down market. So just a few more things on Thayer Street Partners. We're really focused on thesis-oriented investments, where first we'll really examine a theme around some of an industry sector, and then within that build fairly long-term relationships, and out of those opportunities arise, sometimes when we expect and sometimes when we least expect them. Our targeted returns are generally in line with many other players in the market. As a result of our investment and sourcing strategy, we've predominantly had a proprietary origination model, where we're really investing, acquiring businesses or partnering with business owners and other investors that we've had a multi-year pre-existing relationship with. This just gives you a quick snapshot of some of the areas that we are looking in today, and I'll touch on some later. But financial services could be anything from quirky leasing businesses and factoring and receivables businesses, to home services, HVAC services, property management, and things all the way to elevator maintenance, which is actually a big focus of our time today, as these days is in the elevator space. I'm going to just flip forward, touch just very briefly on why we like the lower middle market. We like the lower middle market because we think there's a rich opportunity for excess return. So According to many, returns in the lower middle market have outpaced those of larger PE funds. 94% are lower middle market businesses. Those are businesses with between 5 and 100 million of revenue. We're really focused on businesses somewhere between $2 and $10 million of cash flow or EBITDA initially, that are operating steadily and have an opportunity to grow materially. At the same time, 10% of the institutional capital out there is dedicated to this segment of the market. So we think it's a highly inefficient space still. Just a bit more on why we like lower middle market. We call it LMM for short. We think there's material discounts if you look at average acquisitions for other funds. We're looking at that benchmark because that's closely studied. Many cases it's materially cheaper. As you'll see here, 6.3 times versus 9.8 times for middle market funds. And on the next slide, on average, you're seeing lower middle market funds acquire businesses at 6.3 times and exit at 9 times. There's this material arbitrage that can be harnessed. And with that, there's also less debt. For good and bad reason, these segments are often less covered or less consistently covered by banks or the more sophisticated lenders. And as a result, there's an opportunity to invest in these businesses a bit higher up in the capital structure, a little less levered, which we think over time, provides an opportunity for future liquidity by back levering in the future, but less risk at the onset of an investment. So, from our seat, we're observing a handful of observations within our investment mandate around that come out of COVID and kind of the broader political environment. First two, I think, are fairly obvious. So one's an acceleration to demand for business services to be delivered with tech-enabled enhancements. And that's getting priced into the public market today. That's an obvious theme that comes across if you're watching CNBC or following the markets. The second, which touches on a number of the businesses in our portfolio and pipeline, is products that require regulation or driven by a regulatory need, are going to, have not only survived, but the value of those businesses is perceived to be higher today than it was before. Similarly, businesses that could be sold in a more contemporary fashion versus an old school enterprise in-person sale have a lot more convexity and growth potential as we look at further volatility in the markets and in the way we live and work and operate. The third one, which we're seeing and is slightly more unique, is we're seeing an increasing number of motivated sellers who own really stable service businesses that in general demand is very uncorrelated and resilient. But we're seeing sellers increasingly motivated, seeking liquidity or seeking partnership in this market. So that's what I'm going to spend another minute or so on. As mentioned.
By the way, Josh, feel free to wrap up, any comments on this slide and if there's an overarching theme, but I wanted to get to a few of the questions. Yeah, sure. So I have very quick. So just in mom and pops, we're seeing a few things. So one is mom and pops that have healthy businesses on an underlying basis are really, in many cases, seeking liquidity, full or partial liquidity. Their AR days may be growing if they offer an essential service. Key clients may be paying less. Owners who have a healthy underlying business may be materially affected by other elements in their financial picture, whether it's real estate or other equities, and there's just more complexity in operating in businesses.
And so even though the demand remains the same, the health of these businesses remain the same, there is short-term distress, and there historical forms of capital, which were regional banks or other alternative lenders, or sometimes their personal network don't exist.
Okay, well, thank you for that. And one question we have coming in is if you could just comment on your HVAC services strategy.
Yeah, so within that, we've home services, we've connected with, we focus on property management, home services, including HVAC and other elements. Within HVAC, we're investors in a business that provides leasing to residents that are looking to replace their HVAC equipment. So as an alternate right now, and people are tight on liquidity, instead of spending $10,000 or $20,000 to upgrade your heating and air conditioning, you can acquire that same equipment for $150 to $250 a month with service included in it.
That might be a good thing to follow up on. Any of the questions we see coming in that we don't get to, perhaps we can have some follow-up conversations, and that's what this is about. So moving into our first panel, though, and just to hear perhaps a little bit of the reaction to some of your comments, I'd like to have each of my panelists, starting with, I guess, Katherine, if you wouldn't mind, just if you wouldn't mind, please introduce yourself, your firm, and your main focus in terms of the types of investments, and just generally whether or not you think that the themes that Josh raised are relevant to your efforts.
Certainly, and thank you for having me join, and thank you. That was very interesting, Josh. So my background is I've spent almost 20 years in alternative investments and with family offices. I've worked for 7 single-family offices for billionaires, and my career has been in New York City and Geneva, Switzerland. But 2 years ago, I moved to Maryland, so I was ahead of the curve. Still love New York, and hope to get back there as often as I can. Today, I work for a single-family office, Nottingham Spirk, who's located in Cleveland, Ohio. And their primary largest investment is their engineering and design firm. And they are behind products and partnered with companies you've heard of: Little Tikes, Dirt Devil, Swiffer Sweeper Vac, Halo Bassinets. They invented the spin brush toothbrush. They've created over 1,300 patents. And actually, to Josh's point, we actually do, we have a new initiative where we partner with private equity firms, not only as an investor, but only if we can innovate their portfolio companies. So we did a deal like that last year with Invest Industrial. We bought the company Jacuzzi with them. So we did innovation due diligence, which is a new kind of due diligence, and bought that company for $382 million, and we're a minority shareholder, and we are going to innovate and remake the spa category. But we also like sleepy, kind of overlooked businesses that are family owned as well. So I think what Josh said was really relevant, and happy to comment more about it.
Right, great, thank you. And Herschel, would you mind commenting?
Hi, Kevin. Hi, everybody. I'm Herschel. I represent my family doing early stage investing here in the U.S. The family office is based in Mumbai. My elder cousin sold a couple software companies and has become a super angel out there. So I've kind of taken the mantle and started doing early stage technology investments here in the U.S. We definitely take a generalist view. Everything Josh is saying about lower middle markets, I think he's spot on in terms of the macro and micro trends. While we don't really play in the private equity arena, definitely seeing a lot of opportunities coming, especially with the coronavirus shifting the way we use software. So I'm excited to touch base on that. And also looking at emerging markets, huge opportunity coming in India. So excited to touch base on that as well.
Right, thank you. And Matt, I believe you may just have your picture up. I'm not sure if you're on video, but please feel free to introduce yourself and your thoughts.
Hi there. Yeah, I was watching the conversations here in my office in San Francisco. I am family member and chief investment officer of our own family office, the Iris Family Office, and I run our own investment management firm, Venture Science. Over the last 10, 12 years, we've primarily invested under my investment thesis into private companies in and around Silicon Valley for the most part. We continue with that thesis. We're direct investors. We typically participate in later rounds of companies, and in some special cases, earlier rounds, sometimes primary rounds, other times secondaries. So we're very unconstrained in terms of how we invest and how we operate. I guess in terms of the current climate today, I really don't find it surprising that the tech companies here in Silicon Valley, from the big names to some of the smaller players, have gained such attention and interest and influx of capital, both in the private and public realms, because it's apparent that when you look at the world and maybe close to $100 trillion of wealth that's looking for a home to be deployed, the United States is the best place to invest. It's the safest place in the eyes of investors all around the world. And so when those investors are evaluating the current situation of COVID, unfortunately, the US emerges as the potential last man standing. And so with that, as far as their capital's involved, where to invest is going to be the United States markets, both public and private. And so on the public side of things, clearly the big winners, your Apples, Google, Amazon, Microsoft. These are the leaders. These companies have all the best and the brightest minds and the products and the margins and everything they got going for. And so to me, it's no surprise that their valuation, especially in the leadership of Apple exceeding $1 trillion first and now exceeding $2 trillion, we're going to see a lot of the smaller players start approaching and exceeding the $1 trillion mark. And that's your Teslas and that's your Zooms. And they're already headed that way, because if you compare that to the overall capital available around the world to be deployed, everybody did their rebalancing, everybody reallocated into gold and precious metals and things like that. And so the returns are in US tech companies, and those are the most valuable companies that we produce as a country here in the Western world. And so on the private realm, again, it's no surprise. I mean, these companies that we're seeing here, these companies are creating products and software as a service, software product technology, really, with high margins. These are the most highly coveted companies in the world. So it's important for investors to sort of, if they haven't woken up and understand what's going on in the public markets, to me, it's absolutely no surprise at all. People are very aware of what's going on. So we obviously positioned ourselves over the last 10 years or so with creating a footprint here in Silicon Valley to gain access to highly coveted deals. And we've succeeded in that. And we've had 2 IPOs. The most recent IPO was the IPO of Lemonade, in which we were earlier investors. And right now we have 7 unicorns in our portfolio. All these are known names and amazing companies. And we're going to continue to do that. Obviously, as a family, we do have exposure to most other asset classes as well, from real estate to fixed income. And but the opportunities here in the tech world, whether the current situation could be compared to a bubble or what have you, the frothy situations, and the numbers speak for themselves. I mean, Zoom's recent numbers were outstanding. And so that's what I do. I go after these companies. I maintain our relationships with tech, from engineers to people starting companies to to tech veterans and everyone here on the West Coast. And so once these fires are over, obviously we're going through a situation where there's a lot of smoke around too. And once COVID's over, everyone's more than welcome to please come visit us in beautiful Bay Area. And please add me on LinkedIn or look me up, and I'd be happy to be a good host.
Right. Yeah. Careful what you wish for. We might all come out at once, but
you know what? Come on out. We got plenty of room. Come on
okay.
out.
Well, look, I appreciate all of that, and you're not maybe quite as focused on some of the mom and pops, but I did have a question coming in for Josh, and it's around proprietary deals in quotes. I don't know if anything's proprietary these days, but maybe you can give me an example of how you're finding some of these less competitive deals, and also just how that ties into themes of stress on mom and pops in the lower mid-market.
Sure. So one of the areas of focus has been the elevator space. We've looked at a number of different angles. So we own a business that does emergency response in elevators, right? When you press a emergency button, they pick up the phone and help assist people. And now we have another business that does elevator maintenance in New York City area focused business. And in both of those cases, the investment opportunity emerged out of the idea that elevators were needed and necessary, whether rents are going up or down, the regulation around elevator safety continues to increase dramatically, both on a national and state basis. And so our view was we wanted to get in front of that curve. And the third was there's a lot of fragmentation in the market. So our most recent investment in the elevator maintenance space was one where we had gotten to know over 50 elevator maintenance companies within the New York City tri-state area. We're based in New York City. And we've partnered with one entrepreneur. It's his second time building an elevator maintenance business. And that partnership was finalized after almost 2 years of conversations, workshopping, and collaboration. So he did not hire a banker, he did not hire a business broker. That emanated out of a shared thesis that there are other competitors of his that were in their 60s and 70s that wanted to retire, they wanted to sell their book of business, which are these elevator maintenance contracts that are almost royalty-like, to someone who is respected in the industry and would treat their customers and employees with care. And so, not only was that proprietary, but that business is now benefiting from some of the stress. Not that we should monetize off folks' issues, but a number of relationships that business has with competitors or tangential service providers. Many of those are owned by folks that have said, I don't want to deal with the stress of operating in New York and Washington, D.C. and Boston and Philadelphia. I'm ready to retire. I was going to wait 5 years. I want to accelerate those plans because of the complexities of managing a human intensive business right now. And I'm willing to sell or sell an interest in my business to partner with our platform at a reasonable price. Does that answer your question?
It does. Moving on to Katherine, if you wouldn't mind. I think, related to that, you're largely focused on deals, and I was wondering, how that theme of proprietary deals or, less competitive deals carries in, and in particular in this environment, how are you able to make investments? How has that process changed?
Certainly. So I'll address your second question first. So the business and the family is located in Cleveland, Ohio. So actually things have just turned like over the past week or two. I was supposed to attend a board meeting and I couldn't even fly there because I would have been quarantined. So that changed overnight. So, the situation is fluid, but we had decided about 3 months ago to, even though we had someone in Hong Kong for decades and we are global, we manufacture the products that we invent globally. we decided we'd look in our own backyard. So for a period of time, we were saying, where can you drive? And let's look into the Midwest. There's a lot of these unsexy manufacturer-based in the Midwest, that great valuations, overlooked by Wall Street and Silicon Valley. You know, there's startups there. There's great seasoned, mature companies. So we were looking in, you know, Ohio and Michigan and Indiana and places that people completely ignore. And guess what? There's ripe, interesting finds there. So we are, once the world opens back up, I'll still be on a plane, but definitely I think there's a lot of good gems to be found sometimes in undiscovered places. So we definitely focused more in our backyard. And then when it comes to proprietary deal flow, that's an interesting, very overused term. I can't tell you in my 20 years how everyone thinks they have proprietary deal flow, and it's, a lot of it to me is just not true. I mean, listen, you need to have a connected network. You need to talk to people. You need to talk to everybody in the whole system. You need to talk to investors. You need to talk to bankers. You need to talk to startups. You need to talk to seasoned companies. So, I mean, you know, I think, yes, in our niche, we may have uncovered fund companies before others, but certainly I think a smart person uses their network to source and never turns down an opportunity just because they didn't discover it themselves. I think that is not very smart. So anyway, that's my 2 cents.
Fair enough. And just a quick kind of yes or no, in this environment, are you able to pull the trigger? You know, you're not bouncing around visiting some of those hard to find businesses in the Midwest that you mentioned. So are you able to make investments now?
Well, we've been seriously, we are also, I would say, we aren't doing 100 investments a year. We may look at 1,000 companies and maybe do a handful. So we are seriously considering several, but we haven't pulled the trigger yet, but that's not unusual for us anyway, so.
Okay, yeah, thank you. And Herschel, this may be interesting, given your perspective in VC and high volume of companies that you typically would invest in. And I understand you also work with a number of other investors that you help coordinate and so on. So correct me if I'm wrong, but I'm wondering if you're able to make investments in this market and how that relates to any changes in your process in our new environment.
Absolutely. So it, you know, like what Matt was kind of harping on earlier, I don't think there's been a better time to be a tech investor than now. The reliance on tech, collaboration tools, you know, just ways of communicating is now more than ever. And what's really interesting is early stage companies actually have much higher potential to actually come in and create something new that gets adopted really quickly because we're stuck at home and we're finding new ways to work. So in terms of pulling triggers, you have to. I mean, I did 2 deals just last week, and I mean, we take a volume investment approach in general, but it's worked out well for us. It's a lot to manage, but as a family, we've invested in over 150 startups now, and you know, we've done well in that 100+% IRR type stuff. So we just feel like software and overall tech in general, this is a phenomenal time. And if you're not adapting, if you feel the need to, I need to get to know somebody for many weeks before I pull a trigger, there's so much capital around that you can end up getting left behind. And if you're looking at venture, it's not about the hits. It's actually about the misses. Like the misses hurt a lot more. So if you have the opportunity to invest in something that you feel conviction in, you have to be able to pull the trigger. You know, I can't tell you enough. We have a few companies in our anti-portfolio that I look at now as, man, we had invested in this. This is over 100x, over 200x, and these are moving quickly. So, you know, bullish on a lot of areas. You see what's happening right now with just young people in general. think LinkedIn did a really good study about how people, millennials and Gen Z, look at work. And there's definitely a trend towards higher valence. And it's not just from the paycheck. They're looking to align their views with where they work. And smaller companies are going to be able to fit that bill a lot better than some of these large corporations. And what that means is as these smaller companies gain traction, gain market share, and we're talking 1-2% market share, there'll be insane M&A activities. And when those M&A activities occur, that's when money gets taken off the table, and usually illiquid asset classes. And if you're in early enough, you'll get those multiples that end up kind of making up a portfolio or doubling or tripling the value. So we've been seeing a lot of that happening in terms, and we're also noticing now that emerging markets, this is the time. They've been saying for the last 10 years, the world is flat. You got to look outside of the U.S. And, I do agree with Matt that U.S. is by far the safest, has the most opportunity. But when you look at places like Indonesia and Asia in general, there's definitely a propensity to believe the future is going to shift. You have too large of a population, and given the current trends in immigration and the way the United States, before used to attract top talent, it's shifting now, and talent is staying home. If you look at Fortune or some of these large tech companies, it's not Indian Americans that are running these businesses, be it Google or Microsoft. It's actually Indians from India, and those Indians aren't going to be coming at the same pace to the U.S. So that kind of what they call a brain drain, it's going to stay in home countries, and you're going to start seeing a lot of clones. This is the land of innovation still, the United States, but markets are large outside of the United States. And when you can cater certain products to those markets and develop good tech, it'll actually seep west. And there's no reason to believe that the next software giant cannot be based in Silicon Valley. In fact, we're seeing a decentralization of tech talent occurring right before our eyes. There's an exodus happening. And while I'm long on the Bay Area, it's undeniable that tech can happen anywhere. And when you look at cost arbitrages, there's a reason every back office is in Bangalore. And soon we're going to see a bunch of entrepreneurs come out. And who's to say software can't compete around the world? So we're taking a macro trend, but you have to be able to pull triggers. You have to be comfortable meeting people on Zoom, and it's going to come from your network. What we do is we actually partner with micro funds, seeing a huge trend of these sub $5 million funds and really smart subject matter experts coming, geography centered funds. And we partner with them to do two-way deal flow. So, when you're surrounding yourself with people that are experts in relative fields, you tend to capture top level deal flow. And that's what it's about. If you're going to invest in a lot of tech companies, you have to be in that top 5, top 1% of deals. So yeah, that's just my 2 cents. Thanks.
Oh, yeah, thank you. And Matt, what's your take here? How has your process shifted? As Herschel mentioned, you're more focused on U.S. markets, maybe viewed a little more safely by some people, and maybe it's about access to some of these unicorns, and delving into what he's talking about as far as what people would consider esoteric in terms of investing in India in some cases. How does that relate to SPACs and so on that you're exploring? Help me understand your process.
Let me offer my 2 cents on proprietary deal flow. I mean, obviously, we see that term used generously and broadly, but there is such thing as proprietary deal flow. And if I may give an example, we were earlier investors in a company called HeartFlow, for instance. And this is a $1.6 billion cardiology company, FDA approved, and currently replaces the risky angiogram. Someone we knew from that company left and started working for a phenomenal artificial intelligence and other life sciences company. And then they reached out to us with an opportunity to invest in that company. So all of that's proprietary. That means I have access to it and somebody else doesn't. Another company, somebody I know from Oxford, started a phenomenal company. I know the CEO for a long time. They're also in the artificial intelligence space. We've been having conversations to potentially invest in that company. That's also proprietary. That's also an opportunity that I have and most other people don't have. And others maybe have access to certain other things that we don't have. So everybody has certain proprietary things, and it is true. But if you overuse it, or if it's not true, and if you don't have proprietary deal flow, then that means you're just abusing that term right there. But as far as investing, as an individual or as a family office or as a private investor, if you don't have access to Silicon Valley, maybe try to gain access to these amazing deals by connecting with other families and investors out there. And everybody's more than welcome to reach out to us. At times we do syndications of our deals. And so, you can co-invest in a number of different ways and varieties and forms and shapes into these companies. I mean, don't just, sit back there if you're physically far away from Silicon Valley. I know a lot of people here are willing to share. I mean, as my 4-year-old daughter would say, sharing is caring. And then at the end, we create leverage. At the end, we gain a larger footprint into investing in these companies. And so, co-investing together with other families, I think this is huge. I think it's very important. You avoid the ambiguity and the unknowns of what I call portfolio fund structures, and funds you put money in, you have no idea what companies are going to go inside that portfolio. So you can do that. You can go direct, and you can kind of from there start getting your way into it. But in terms of investment structures, because we're sort of unconstrained how we invest, we always scan the landscape for opportunities. For example, SPACs are an opportunity that we're exploring today to potentially, take a Silicon Valley company or another company that we might know, take that company public through that investment vehicle. I encourage people to look into PIPEs. I encourage people to read the direct listing ruling that the SEC released last Wednesday evening. I encourage people to read the letter that NASDAQ wrote to the SEC in asking for permission alongside New York Stock Exchange's permission that was approved. And so, you need to read those. If you don't understand it, have your legal counsel, somebody read it and explain to you what it is, because private investing and public investing is also changing. You have to remember that the public markets are very, very old. They're 400-500-year-old investment structures, and these are changing. And so you don't want to find yourself in another webinar or a conversation, 3 years from now, oh, wow, how did this happen? That happened. And instead, proactively engage and try to stay on the forefront of the curve here, that way. And at the very least, you'll find some interesting angles that you can kind of insert your own investment strategies in there. And so that's very, very difficult. It's easier to kind of be a follower on the general trends. But if you can position yourself on the forefront, then you can really get into some amazing situations, lucrative situations.
Yeah, thank you. And Josh, moving on to you, because we had something on the box here about your proprietary efforts, and we're going back and forth here. So I'd like you to maybe tie that in, because we're going to run out of time, maybe have one more round here among the speakers. So if you could tie in how you're able to maintain some ability to find relatively proprietary deals, if not completely, and also whether or not that takes you into more esoteric areas, or if you're sticking to your knitting. Yeah, just help me understand that.
So I think our knitting is probably esoteric areas to begin with. So I think we're still there. We're trying to pursue the more unsexy, more unusual areas. If your question is how we find that during COVID, I think again, maybe it's not an exciting answer, but it hasn't changed much. I think to touch on something that was mentioned in the previously, building relationships with folks can come in different forms, and it kind of depends on the counterparty. Some folks are very comfortable sharing and talking openly and really getting to know us on a Zoom. Others require an in-person. I think we're fortunate in that our sourcing cycle is a bit longer dated. So we have the benefit of investing in businesses today that we've gotten to know long before COVID. However, it's going to be very interesting to see how this evolves over the next year, or if this, if this kind of suspended reality continues even longer. I think new relationships, and we're already building new relationships through primarily video and an occasional but much more focused in-person meeting outdoors, socially distanced, et cetera. So I suppose we're fortunate because our strategy is a little more long dated as it relates to opportunities.
Yeah, thank you. And moving to you, Katherine, perhaps you could help us understand, whether you're moving into anything a little more esoteric, or if you're sticking to your knitting in particular, since, correct me if I'm wrong, but Nottingham Spirk's been around for 48 years and, really have a basis in engineering and industrial design and so on. It seems like you're very focused on what you do best, but maybe you're finding ways to capitalize on new areas. We even had something come across on the box asking about what's interesting in cannabis. I mean, I don't know how far afield you may go from your core expertise. Help me understand that.
Well, here's the thing. I would say, think about us as devices and hardware. But so a pure software company, we wouldn't do, because the founders don't have expertise in that. We have 75 engineers and machinists, designers, prototypers on staff. So we want to use that. But think about how devices, wearables, cannabis, we have security issues. We are into robotics. I mean, last year, we created the first autonomous golf caddy, and it won as the #1 PGA Tech Innovation of the Year. And this thing follows you around. The cool part about it is that there's an internal gyroscope. So we figured out how it can follow you around, but it won't tip over or go into water. And that has massive applications in military, hospitals. So even though that's like a fun project, the point I'm trying to make is that although we have not evolved outside of physical hardware and devices, within that, so we've done, like we did a wearable for the television show, The Biggest Loser. It's where, the weight loss television show where that woman, Jillian Michaels, yells at everyone. We did the wearable for that, right? So again, all of these, cannabis, be it healthcare, be it, even the jacuzzi, think about how there are applications in AI for all of these devices. We're doing Factory 4.0, which is measuring, vibrations, temperature, all of that within a factory. So although we've been around for 48 years and stay within hardware and devices, we evolve with technology to use our knowledge in those areas. And like what Matt said too, we also co-invest with other family offices, and whenever one of our portfolio companies is raising money, we just let everybody know, hey, we designed this device, or we invested, or please take a look. So we really encourage our network to look at our portfolio companies too.
Right, thank you. And Matt, we're running out of time, but since she referenced you, what's your take here?
On which question?
Just generally, how far afield are you willing to go? What are you seeing? What esoteric either strategies or segments within? Well, I mean, you've done a bunch of different things, from venture to now SPACs and more, publics with unicorns and so on. So, what's the most esoteric thing that you're getting involved in? What's interesting?
Well, I mean, it's important for us to sort of, stay unconstrained and try to stay ahead of the curve, understand different, capital structures, new capital structures, but we also have a certain, internal thesis around what we invest in. For instance, today cannabis is an interesting subject, but under federal laws, it's still illegal. So we're not going to invest in cannabis until all the laws, not just local laws, but all the laws actually come up with, and then also from an understanding of how it really plays into the medical space. I mean, before you get to cannabis, there's so many amazing opportunities in terms of drug discovery, in terms of genetics, in terms of everything else that's out there. So, and it's also important for us to kind of keep our investments uncorrelated, as low of a correlation as we could possibly have. So not just pile up into a certain vertical, so to say. So we're continually doing that. Again, always open to, inviting other families into, our deals, if it fits with their first family mandate or their thought process or however they want to invest. And in a given year, we only do about 2 or 3, maybe 4 investments anyway. So between now and the end of the year, we're in September, beginning of September now. So we have 4 months till the end of the year. Maybe we'll do 1 direct investment, and then we have a SPAC initiative that we're kind of exploring and working on. We'll see how that kind of shapes itself up in the wake of what's going on today. But that's essentially what it is. I mean, we don't try to make massive changes. We don't try to get too esoteric, but this thesis that we've kind of created over the last few years, we'll just continue down that path.
Yeah, thank you. And carrying us out here, Herschel, what's your thought? And I know that you invest with your brother as a super angel, a number of other family offices that you work with. So maybe you can even tell us if there's a consensus around new areas that people are exploring besides your Indian theme.
Absolutely. So just in terms of the cannabis question, we looked at cannabis a couple of years ago. I think there was a big dip in 2019, but after a huge kind of wave in 2018. I would trust the professionals there. The reality is, like what Matt was saying, these laws are a little bit finicky, and there are people that are spending full time in the space. So any kind of co-investment that comes with me from people networked and spending 24 hours a day looking at cannabis deals, their thesis is going to outweigh my thesis every time. So surrounding myself with people that are smarter than myself in particular sectors is very important. Some new stuff that we're looking at and very bullish on are crypto. I think that there's a global wave coming with young people looking at these kind of decentralized assets. And I can't imagine the next generation Gen Z not buying into this concept of decentralized currency or decentralized assets. So this is coming. I think it's still a bit early, but it's time to get the feet wet and looking at them. And then at the same time, the other vertical that I'm very bullish on is EV. I think Tesla's just touching the tip. I think that this trend, it's just going to be reality in the next 20 years, where I think every single person in the audience will be driving some sort of electric vehicle. So really, really honing in on that economy, on how clean tech and the way that we actually move. This is going to be very interesting. So trying to use macro trends and then surrounding myself with people that are in that space is crucial, and that's how we can corner proprietary deal flow. I think piggybacking off of people that are entrenched is the way to go.
Thank you.
If I may add, Kevin, one thing to Herschel's comments about crypto. We invested in 2 of the 3 top crypto companies out there, as equity investors, both Ripple and Circle. And so, this efforts, obviously blockchain, has a true tech promise. But whether it's crypto or any other company, one part of our thesis that I think forgot to mention is that we only try to invest in best of the best. And so, you pay a higher price in doing that, and especially when it comes to highly regulated spaces like crypto or like cannabis, even though we haven't invested in that space at all. You really want to invest in a established company and the best of the best, and try to find your way into that. And because those are the companies, they will have the technical background, they'll have the capital in the bank, they will have hired, people at all various levels of that effort, whatever it is that they're working on, and that applies to everything else. And so our thesis is we try to only go after best of the best. We try not to go to second best. So if we were to give an example, if we were to buy real estate, we would only try to buy around Central Park, New York, even though other places are up and coming and carry certain value itself. It's just the difference of mindset and how we look at it.
Right. No, I certainly agree. Finding quality, and as Herschel alluded to, finding the the right people to surround yourself with, and capitalizing on our changing reality. You mentioned reality there, Herschel, and I think that's important. So as we navigate our new reality, we're going to hear some more takes on what's going on in the market. I'd like to pass off to you, Jonathan. And as I hand off, I'd just like to introduce him. Jonathan LaCrosse is founder of LaCrosse Investments 37-4. He's operated in roles as an LP, a GP, and for the past decade as a placement agent, raising over $4 billion, and has put over $4 billion to work as an LP. So he has a great perspective here, and I've worked with him over the years to assist with roadshows and LP introductions, as he worked with a number of private equity and venture capital clients. So I've seen him in action, and on a personal level, now that I'm working with LaCrosse Investments, I've viewed him as a force for good in the fundraising market, and I've been happy to work with him more closely over the last few months. So Jonathan, with that, please share any other highlights on your background, and let's make some introductions for the other panelists, and the floor is yours.
Great, thank you so much, Kevin, and really appreciate the comments on the first panel there. If everybody needs to take a breather and stretch, please do that. But we've got some great additional attendees here that will be speaking over, call it, the next 30 minutes. So look forward to getting their insights. I've been investing in and around the private markets for the last 20 years, and have seen some interesting opportunities, whether it be across distressed or special situations, royalties, etc. So the theme today will continue to be esoteric strategies, special sits, and unique investments. So look forward to getting the perspective of the folks on the panel. We have 4 distinguished LPs here, and one GP/LP. So without further ado, let's have each one give a brief overview of themselves and their firm, and any in particular areas of interest, with the theme sticking towards esoteric and special sits. So with that, Alan Lottle from Campton Private Equity Advisors, with that beautiful background of San Francisco. That'd be great.
Great, thank you, Jonathan. Alan Latta with Campton Private Equity Advisors. We advise family offices on their private equity investment programs. That's primarily fund investing, but also we'll look at co-invest, direct invest, and opportunistic secondary transactions, both fund secondaries and direct secondaries. Strategies are primarily lower middle market buyout, growth equity, venture capital, private credit. But we have been looking at a variety of, if you will, esoteric strategies. We have looked at cannabis, but to paraphrase a former president, we didn't inhale. We are currently looking at things right now that we find of interest are litigation finance, which I think is a pretty interesting area. Life settlement funds, I think is also pretty interesting. Also, we are in the process right now of learning more about esports. I think that's also a very interesting and rapidly growing area. So those are kind of a few, we're looking at many others, but those are kind of a few of the ones that I think are a little more, if you will, off the beaten path.
Thank you so much, Alan. Jeffrey Horvitz is next from Moreland Wealth Services Corporation, a single family office, and one of my favorite LPs out there. So Jeffrey, I'll turn it over to you if you can comment on the same.
So we're one of a handful or less of SFOs, single family offices, that derive from the same source. Basically, my grandfather, who was basically destitute as a child. So over 120 years, approximately, wealth went from zero to a lot. And a lot of it was really through operating businesses until they were all sold in the late 80s. By dumb luck, at the peak of Drexel's hyper-levered era, the very end of that. And our first private equity investment was done in 1989. The family office was started in 1987. During the sort of first half or so of all this, I was the sole effective CIO, although without the title. My main business activity is still that. My academic background has nothing to do with this at all. I have 2 graduate degrees and more or less ABDs, one in sociology or psychiatry, the other in social psychology, 2 different universities, which turned out to be actually useful, but not for the reasons most people think. I taught the research methods course at UCLA, the Department of Psychology, every trimester I was there. Later ended up being just fortuitously an art dealer for quite a while in Los Angeles, which was great, and ended up working in our very large southern operations, primarily large-scale land development and building materials, until they were sold in '87. We found ourselves in the investment business. The real great thing about it was we knew absolutely nothing about investing. That turned out to be a godsend, because I was sort of unencumbered by what everyone knew. So more or less went about educating myself very systematically in this. And the certain ideas that I got in from various different sources informed the general sort of policy level of the investment portfolio. An important one of which is that I have no ability to predict the future, and that if I want, if I just hired very smart people, I would lose a lot of money, because I could just pick people off the MIT campus who knew nothing about investing. So being the dumbest person in the private equity type fund world or in the investment world is actually pretty smart. If you get too smart, you'll have trouble dealing with what is often the obvious. So in the early years, I basically invented 2 products, which are our public stock products, which are passive but not indexed. They don't come out of finance theory. They come out of things like statistical estimation, expert estimation, things that are at best tangentially related to normal investing. The other half of the portfolio is private fund investing. We, both the public and the private, are approximately 1/3 US, I'm sorry, 2/3 US, 1/3 Europe. Even at the present time, we have about 40 manager relationships and about 120 fund line items, 20 of which are sort of end of life, and 100 are active. Nonetheless, and this is one of the great conundrums to explain, which would be probably an hour lecture as to why, but we actually do extremely well despite the hyper diversification. And it has a lot to do with really sort of the mathematics of compounding, skewness, et cetera, which I won't bore you with right now. My sideline is taxable investment management. I'm the co-author of the CFA monograph on the topic. I have this sort of continuing academic side of me, the research, but in a different topic. So I published in a number of the peer review articles. Almost nothing is contrary, but a lot of what we do is unusual in the way it's approached. So we are actually, as I explained it, in the risk management business, not the prediction business. I cannot regale you with any stories of my brilliant choice of managers, companies, funds, topics, etc. In my view, that in the investment world, broadly speaking, luck dominates skill. And if you want to compound wealth over very long periods of time, you really need to reconsider making big hits in a few things, because it's not, our time horizon is sort of a rolling 75-year window. And if you work this out, what the math is of the money that sits while you're waiting, it's very hard to sustain this over multiple generations and decades. We also have issues of just sustainable governance with a very small number of family members, and building up a very specific skill set that's highly dependent on one or two people is very hard to sustain over multiple generations. So as much fun as this might be, I don't do that because my responsibility is to grow and maintain the wealth across multiple generations, which I've described as a large stream out of which you can drink, but you cannot divert or dam it up. And so that's basically how we operate. I am planning my retirement. I'm 70. I'm planning my retirement in about 25 years now. So, you know, I really have to sort of think carefully about what happens.
Thank you, Jeffrey. Appreciate that. So another one of my favorite LPs and former colleague, who arguably one of the best hires I've ever made, and when we were with CalPERS together, Mark Perry, who's managing director of Wilshire Associates. So, Mark, if you can give an overview of yourself and your firm, and you know, anything on the esoteric side. I know you're looking at a number of things. Maybe you can comment on one or two that are a theme right now that you're looking at. That'd be great.
Well, thanks for the introduction there, Jonathan. It's great to be on the panel here with you. My name is Mark Perry. I'm a managing director at Wilshire Associates in their private markets group. So we're a team of 45 people spread across US, Europe, and Asia, whose 24/7 is everything private markets, private equity, private credit, private real assets, and everything in between. The in-between part of it, the more esoteric strategies, the more frontier strategies have been an area that we've been quite active in, frankly, over the last 5 years, really more from the yield angle and substitute yield angle than anything else. And so, you know, in recognition of some of the risk that was building in the kind of the core of the private credit market, you know, post GFC, as our clients came to us asking for yield, we delivered that in some really creative ways, we think, through some of these more specialized, more esoteric strategies, a good complement to existing private credit portfolios, a good substitute where appropriate. So we have some pretty mature views on those parts of the private market I'm happy to delve into on this panel.
Great, thanks, Mark. Look forward to doing that. So last on the panel, but not least by any means, is Don Winter, founder and CEO of DLP Real Estate Capital. Has built a real empire, and he's fairly young, and so this is a guy we're going to be hearing about for many, many years. So, Don, if you could introduce yourself and give an overview of some of the interesting areas within real estate that you're playing, and anything else, that'd be great.
Thanks, Jonathan. Appreciate it. So as Jonathan said, my name is Don Winter. I'm founder and CEO of DLP Real Estate Capital. I founded the company about 14 years ago in Bethlehem, Pennsylvania, Lehigh University area, hour north of Philly. That's where our Northeast headquarters is today. And then we have a Southeast headquarters here in St. Augustine, Florida, which is where I'm talking to you from right now. So DLP Real Estate Capital is a private real estate firm. We do real estate private equity, private banking with a focus on investment housing and really a focus on building elite organizations. What we do on a day-to-day basis is we invest in, we operate, we build, and we lend on investment housing, which is income producing single and multifamily housing. Specifically, we acquire value add rental communities, and we lend on short-term bridge financing to other housing investors. So not nearly as exciting as some of these other great panel members, unless you really find cash flow exciting, because that's really what our big focus is. We have about 400 employees we call team members. We just broke $1 billion in AUM a couple weeks ago. We own about 12,000 rental homes right now in our portfolio. We run private investment funds. We have $1 billion evergreen REIT, real estate equity REIT, and a $500 million mortgage pool private REIT as well. And just a couple highlights of kind of the effects of COVID on what we're doing in this world we're in today. A little different than maybe if you're not deep in touch with these businesses, that probably different than what everybody hears. So through COVID, we've had record-breaking occupancies in our portfolio every single week now for 18 or 19 weeks. So we've had all-time high occupancies. We've actually had good rent growth. We've certainly dealt with some modest delinquency increase as we've been unable in most of our portfolio to evict residents. But the dramatic increase in occupancy has actually led to record high cash flow multiple months here over the last number of months, which has been exciting. The other interesting thing is the multifamily, the investment housing space, cap rates have only compressed from what we're seeing. Yet there are individual seller distress out there. So we're under contract right now to acquire a little bit over $1 billion portfolio right now, one of the largest privately owned portfolios in the country, from a seller in distress due to other aspects of his portfolio. And then on the lending side of our business, we have over 500 loans out to real estate investors right now. And we have not had one default through all of COVID, not a single default, no forbearance agreements, no modifications, no deferred payments. So we've had great execution that, the markets remain very strong on the single family side and multifamily side. Rents being collected much better than people expect. Home prices and home sales are very, very strong. So all in all, it's been a really great time to be in investment housing, despite the challenges around eviction through these last number of months. So appreciate the opportunity to be here.
Thank you so much, Don. Appreciate that. Let's go back to Alan and your comments about litigation finance and life settlements, because those are definitely out on the margin. However, the statistics that I was looking at, and I've been told by one firm that's out raising a litigation finance fund, is that there, over the last, call it 5 years, about 40 firms have raised, call it $10 billion for litigation finance, and the market is about $200 billion. So still, plenty of opportunity out there. So, but obviously this comes with some risks. This comes with some perceived, that you're helping, encourage more lawsuits. So maybe you can just touch on that area in litigation finance, and then obviously with life settlements, an area that we looked at many years ago, and obviously people just don't want to bet on death, so but obviously very, very steady returns. So if you could comment on both of those, that would be great. Thank you, Alan.
Sure. So echo your comments for litigation finance. It's a large and rapidly growing market as it becomes more and more established. I started my career as a lawyer, although I was a corporate lawyer, so not on the litigation side. But so some of the things that are interesting about this. So effectively, what it is, our funds basically finance the attorney fees and expenses of a litigation or an appeal in exchange for a portion of the award. And so if there's no award, the fund gets zero. So it's a fairly binary result. The nice thing about it is, at least from the funds that we've been looking at, looks pretty uncorrelated with the broader markets and really with the economy. So that's actually one of the nice things about it. It's also, for the funds we've been looking at, looks like it's a little more of a shorter duration for the fund life. So we're seeing kind of funds that are, some are coming with an initial term of 6 years, some are 8 years, but a little bit shorter than some of the private equity funds out there. One of the things that we're trying to get our arms around is kind of the risk profile of the underlying portfolios. So the way this works is these funds basically have really smart litigators that they work with that analyze and assess the suits or the appeals and the potential outcomes for them. But you're not going to get them all right. That's the one thing about litigation. And as I said, it's a binary thing. So if you settle or you win, there's a return. But if you lose, you get nothing. And so one of the things we're trying to get our arms around is the profile of the underlying portfolio investments in these. And from what I can see, kind of that loss ratio looks a little bit like early stage venture. So you need to get we're working right now to get our arms around that loss ratio and how we can get comfort around that. So that's kind of where we are on litigation finance. On life settlement, that one's also pretty interesting and a rapidly growing market there. It's a little less sexy. You are, in a sense, as Jonathan said, betting on death. But effectively, what these funds do is they purchase life insurance policies from people who decide they don't want them anymore, don't need them, or can't afford them. And the fund continues to make those payments and collect the life settlement on maturity. And so the thing about that is it's a little more predictable. So we're in the process right now of learning about that. This is also pretty uncorrelated to the broader markets and to the economy. So that's why we're kind of looking at this as well.
Excellent. Thank you so
We
much.
may be able to add a little color since we've been doing this type of thing, these independent returns, all sorts of them, for now a little bit beyond, I think, 6 years, and are giving it up. Each of the topics has its own, it is true they're uncorrelated, but so is cash. And each has its own characteristics. In litigation, what I concluded is probably if you're going to do this, you need to do it with an enormous number of positions. And the predictability in the court system, sadly, in the US is far, if law were clear, you wouldn't have near this amount of litigation. Also, being a lawyer does not mean you're necessarily actually very good at predicting the outcome. There's a whole bunch of factors, which includes particularly which circuit, if you're in federal circuit, which circuit you're in, who's on the panel. There's multiple layers of randomness almost that come into play as to the outcome. And most of the funds don't have enough positions to actually, the risk is actually enormous and quite random. In other words, the cross-sectional dispersion of sub-portfolios of litigation financing should be quite large. On life settlements, this is really an actuarial question. It turns out, if you press them, most all of them use one of 2 or 3 firms for the underwriting. The problem is that means almost no one has any special insight into the conditional probability of mortality because they're using the same models. That means that it's primarily a deal flow question, and to some extent it's a pricing question involved with a winner's curse, which is you got to pay more than the other bidders. So if you want scale, you will converge toward the actuarial outcomes, but you'll also have to be involved in increasingly competitive pricing at the margin to get enough positions. So again, each one, we've done just about every variant of this sort of thing. Almost all of them were underperforming their own underwriting, taking longer to have distributions, and from a taxable investor's point of view, generate an awful lot of ordinary income. But aside from that, they're fine.
Thanks for commenting on that, Jeffrey. I do want to be mindful of our time. Somehow time continues to fly. But the area that I think you're the most adept at answering is regarding investing in art. So according to the Wall Street Journal, almost 8% of total wealth is held in passion investments such as art. One professor, Michael Moses, was quoted in 2018 that having 10 to 20% of a net worth in passion investments is reasonable. Art has a very low correlation to the equity markets, and I've seen some opportunities to invest in funds related to investing in art. So in your experience, what are the pros and cons for institutional investors? Maybe not single family offices, but institutional investors of investing in art.
I've given numerous talks, including at the Federal Reserve in Boston, about this, written about it, done it for the CFA. I can spend several hours on the cons and about 3 minutes on the pros. The essential problems, to sort of just boil this down, is that the people who do this don't really understand. The key problem is transaction cost. So if you look at Sotheby's and Christie's as first of all, the art market is not a market. It's many sub-markets that have very different supply-demand characteristics, very different. And if you look at Sotheby's and Christie's as a proxy, the vast majority, 98% or something of all lots at the major auction houses sell for under $1 million. And the transaction costs for those are, it's a little more complex, but it's basically 10% if you're a retail seller and 25% if you're a retail buyer, any buyer. And it goes down a little bit on the sell side if you're a dealer or probably very large ticket items. The number of, if the stock market had transaction costs of what is effectively, let's say, 10 to 35% each way, that's one-way transaction cost, there would be no stock market. So remember, if you're an investor, you have to buy it. Middleman's going to take, let's say, even on a great day, 20%. And when you sell it, someone has to do that. So if you don't, the auction house rates are higher than consignment to a dealer, but a dealer has a fraction of the potential buyers that the auction houses do. So you can either have a very large exposure to a very large number of buyers at a higher rate, or a much smaller number of buyers at a lower rate. And if it doesn't sell at auction, it's called burned. Now the value has dropped because it's public that no one else wanted to buy it. You might get lucky on a single item, and there's intense bidding for something or other. I lose out to stuff all the time. So there's also problems of condition, storage, insurance. So a dealer pays basically ordinary income on inventory profits, and they can deduct the expenses. An investor cannot. The federal rate from a taxable point of view is 28% capital gain on collectibles, not the 20% plus it's 28 plus the 3.8% Medicare. If you're institutional, you don't. The predecessor for all this was actually the British Rail Pension Fund in the, when did they do it? In the 80s. And they did it to keep up, they thought, with inflation. It kind of did that, but actually when you break down how they did and how they did it, by the time they paid their advisors and all the costs, only a few subclasses actually did well, which was at the time Impressionist and 20th century modern. I think it was primarily Impressionist. If that does not continue, and right now you start to saturate at the Francis Bacon level, the Basquiat level, the multi-tens of millions, it's a very small number of buyers. So it becomes a little like musical chairs. If you own it and hold it, at some point you saturate those buyers. And it is not true. What you've seen lately, meaning lately in the art world is the last 20 years. If you go back to 1974 and the oil embargo, what happened to the art market in 75 and 6, it completely shut down. Francis Bacon's Lee Radwell's, I remember this vividly because I was an art dealer. Lee Radwell's full-size Francis Bacon vertical painting with a red background eked out a bid tediously at Sotheby's of $100,000. That same painting today would be worth 60 million, maybe 40 million. But there was no way to know that that one would and others don't. I can give you a long list of artists that were hot for a while. Probably the name Sandro Chia does not ring a bell. Sandro Chia was the leading Italian artist in the Art Povera movement that was the hottest artist for a nanosecond, I think in the 80s. It's very tricky. And so even art lending is, even at a 50% seeming loan to value ratio, is fine until it isn't. But these are not outcomes that have Gaussian, bell curve type distributions. It's very specific. Taste changes. Brown furniture, meaning English 18th century primarily and French 18th century, go for nearly nothing except the top 1% of 1%. That whole furniture business has collapsed. You can buy 18th century stamp signed real French chairs for less than you can pay at Ethan Allen's. So anyway, as Virgil and Dante saw on their walk, abandon hope, all ye who enter here. It's not for amateurs.
Well, thank you. Excellent comments. I knew you'd have a great perspective there. I want to get a couple more comments in here from Mark and Don. Mark, first to you. I'm going to throw you a little bit of a curveball from our pre-webinar. But so I was looking at our old performance when we were with CalPERS, and the best performing fund in there was a biotech fund. And biotech has been quite hot. I can't say it's necessarily esoteric, but some of the things that they're investing in that I can't pronounce are certainly esoteric. So what are you looking at in biotech? Why is that an area that might be of interest for Wilshire? If you can comment on that, that would be great.
Yeah, that's it's an interesting market. Certainly something we cover at Wilshire. One of our themes coming out of COVID is around a healthcare refocus, where biotech and pharma are prominent within that. Pulling it back to kind of the esoteric theme, we found some very interesting opportunities in, call it life science lending. Where there's a pocket of inefficiency in the healthcare market, where companies that are immediately post FDA approval but pre-scale commercialization have limited financing options, specifically limited debt financing options, right? So they're post FDA approval. The binary risk of that, phase 3 data is really behind them, right? They have their intellectual property set. but they need to build, an organization now and a system to monetize that IP. Historically, they've used equity, late stage venture equity, 20, 30% cost of capital type stuff. But what's emerged in what I call an esoteric space is a debt product for that market. And so these firms will lend to these companies at this very specific stage in their life cycle, 20, 25% LTV on a volatile V, but nonetheless, a good margin of safety there, and get a set of terms both on return and risk that are kind of like the good old days in direct lending. A really healthy spread, the free upside warrants and upside participation features, a really strong set of covenants and other downside protection mechanisms that make it really interesting. So, an example specifically in biotech of an inefficient market, and there's a handful of firms that have built strategies to extract value from it.
Thank you so much, Mark. Appreciate you commenting on that. Don, you had talked about your portfolio doing quite well with no defaults. So that's extremely, sounds like it might be extremely rare for most real estate investors, depending on which space that you're in, if you're in retail or some of the other areas. So can you just talk a little bit about how you're conducting diligence in this COVID and this limited travel environment, and how you will continue to be able to do that through this fall period until potentially there's some kind of vaccine? And then also if you could comment on if you're more concerned with managing the risks in your portfolio or missing opportunities. So a couple quite final questions there, if you can comment around those.
Thanks, Jonathan. So the no default comment was related to our lending book of business. We're doing first position real estate backed lending. So an average of 54% loan to value, 73% loan to cost, and lending basically a 6 to 12 month loan to a professional real estate investor. So this is a guy worth $3 million, $500,000 liquidity. He's completed 30, 40 real estate investment deals. And we're giving him the money to buy a property, improve it, and then either sell it or refinance us out into permanent debt. So our debt isn't, long-term income produce driven assets. It's the short-term duration to improve an asset. So some of those properties are not even, producing any cash flow as they're under renovation. So even some of the effects related to unemployment and such don't affect that loan. So we've had to do no forbearances. We've had to have no deferred payments. Every payment's been paid, automatic ACH first of the month, and had great performance. So when COVID hit, what we did to improve due diligence on our borrowers, we basically continue to do what we've always done, but we just lowered leverage even further, which because the capital markets in this space kind of blew up back in March, like a lot of industries, most of our competitors were completely on the sidelines as they sell their loans to Wall Street. We balance sheet our loans through the entire duration. So we weren't dealing with the volatility of the secondary markets drying up. So we were able to stay active for our borrowers, but we lowered our leverage. We added interest reserves on loans that we funded through COVID. And we only lent to, we call it tier one borrowers, really experienced, high caliber types of operators. So, it's gone really well. In terms of our ability to do due diligence, we have continued to, the month of April was a little challenging, but really since then, we've continued to go out both on the lending side and our side where we acquire assets. We did acquire a 400 unit community about 3 weeks ago for $54 million. We've continued to go out and do our on-site due diligence, continue to travel. We've done more road travel than air travel. But we continue to go out and do our due diligence, continue to inspect apartments, continue to use third parties. Lead times have taken longer with third parties to get the inspections done. But our physical inspection, our team has been incredible. They've been more than willing and anxious to travel and get out there. So that's been one of the big reasons to why we've been able to perform on our equity portfolio is we've kept all of our communities open all through COVID. So we also talk about the medical industry and stuff, being, these superheroes working through this environment. The team that works on site at these rental communities have done the same. They've been going out, servicing residents, dealing with maintenance requests, leasing apartments, staying in these communities. We've certainly staggered hours and done some different things, but they've continued to work in these communities. And that's part of what's given us a big advantage is a lot of our competitors kind of shut down their offices and said, sorry, we're not leasing apartments. Sorry, we're closed. So we've taken a disproportionate share of the available residents in a lot of these markets. And that's really what's helped us continue to skyrocket our occupancy. So we're certainly, like many, we kind of sat in April wondering, what's going to happen. Is there going to be a correction in values? What should we do? And but remained, really in touch with the market. And we're anxious to do deals, but we never operate in a structure where we're under any mandates to do so. It's been interesting. There's been a lot of reasons why deals get delayed and things don't move as quickly as you may hope, but we continue to be able to close deals, especially on the lending side of our business, and while paying close attention to the volatility ahead, and what's going to happen if these eviction moratoriums continue to get extended, as they likely will, and how that'll affect some of our day-to-day operations, some of our underwriting, how it'll affect the debt and the reserves. So there's certainly variables we're having to deal with, but it's been exciting times for sure.
Thank you so much, Don. I'm glad to hear that you're allocating and putting money to work. I know we're well past our time here, Kevin. So with one word answer, if you could just say if you're allocating to funds these days or if you're on the sidelines given COVID. Mark, do you want to just touch on that? Just a couple words as far as you can be as simple as yes or no, or if you want to expand on that, it'd be great.
We're absolutely allocating, prudent with our digital due diligence, but it's been a busy year.
Alan?
So both. Some of our clients have pulled back while others continue to allocate.
Great. Jeffrey?
If we can't we'll do re-ups where we already know the manager in some fashion. Sometimes we know managers we have not invested with, but we've done all the due diligence. For some reason, we haven't done anything specifically. But in terms of new relationships, if we can't have an in-person meeting, I would just as soon wait. This has only been going, it seems like forever, but it's only going on since mid-March. And I think it's better to be cautious. Plus, there's too much, not just uncertainty about the result, but about how all this plays out at the macro level and the micro level. And our condition normally is fairly fully invested anyway. So we're not giving up much to just stay back. And I learned too much with an in-person meeting that I cannot learn in even the best of Zooms.
Totally understand. Well, Kevin, Don, you had a final comment there?
Yeah, I was gonna say, yes, we are. So we invest with managers. We do it at the asset level. Yes, and we've been doing face-to-face meetings, through this. People have come to our offices or we've traveled. We actually held an event with a bunch of managers in June in Asheville, North Carolina, had 34 managers come. It's certainly been more challenging, but we found people are able and willing to travel we follow masks and distancing and all the guidelines, but we've continued to operate as close as we can to normal.
Well, that's great. Well, I live here in Boulder, Colorado, which seems to be one of the more liberal cities in America. And we're meeting in person. So if we could do it here, you could do it anywhere. With that, Kevin, we'll turn it over to you and for final comments.
Yeah. Thank you very much. And thanks for leading that discussion there, Jonathan. And thank you to all of the speakers that have joined us here today. I think clearly the biggest problem, which is a good problem to have, is that we don't have enough time to delve into some of the specifics where each of you have incredible expertise, but I really appreciate your input. I look forward to the times when we can get together in person and talk about some of these issues. In particular, Jonathan, you're out in Colorado. I'd love to get out to the mountains right now. I'm trapped here in Manhattan. Don, I have to give you a shout out in Bethlehem, Pennsylvania. I'm Lehigh alum, and perhaps we'll share a beer on the south side, or I don't know if you're on the north side. But anyway, I look forward to getting together with all of you. I thank Josh Koplewicz again with Thayer Street and LaCrosse Investments for supporting. You know, I appreciate all of you for joining, given that, you know, this is vacation time for a lot of people. You know, I'll follow up with many of you in the coming weeks to find out what topics we should be addressing moving forward and how we can build this community. As I say, I think that's the best tool we have in the private markets to figure out what strategies and areas we should be pursuing. As a reminder, Private Markets Insider is a platform for identifying investors and deals through relevant content and our community. And the marketplace is coming this fall. We'll talk to you more about that. We'll be doing more to focus on individual deals and building a marketplace, and that will be useful to all of you if you help us to understand your goals and preferences. So that's why we'd like to follow up and chat soon. Meanwhile, enjoy your Labor Day holiday. If you're here in the US, enjoy the throes of summer, put on some sunscreen, and stay safe and sane out there, people. Thank you very much. Bye now.